Hello and welcome to the download. I'm your host, Dave Richardson, and it's always great to have one of our favorites, Sarah Riopelle, who manages portfolio solutions at RBC Global Asset Management, among about a million other things. You're kind of just a big deal, I guess, is the way we describe you. Is that's probably what I know. I let my mother make up my title, and I'm sure your dad would came up with this one for you.
Maybe. I don't know. Have you ever heard the term herding cats? I think I'm the chief cat herder.
Is that
Did
your
you know?
official title now? Managing Director Cat Herding?
And cat herding, yes. I seem to spend a lot of my time organizing people and moving them towards the a similar goal.
Well, I mean, it's the same kind of thing when you're putting portfolios together because you're pulling everything in and
Yep.
building it all together and moving it around all the time. So it would have given you a good experience for cat herding.
Yep, for sure. It's all about staying organized and making lists and making sure everything's moving the way it's supposed to be moving. And
And
then
and then
when something happens that's unexpected, make sure that you can adjust quickly, right?
oh, you mean like the war's on, the war's off, war's on, war's off,
Exactly.
war's on,
Yep.
war's off.
Yes.
And
I was leading you into that question.
were you really? So we've got another escalation, maybe. Uh, feels like it is, but how are you reacting to that?
Yeah, well, the ceasefire that's been in place since mid-June collapsed earlier this week after Iran fired some missiles at vessels transiting the strait. But this morning, though, the situation seems to be calming again with some comments from President Trump. So, as you can see from the events over the last sort of few weeks and months, that it's a volatile situation that seems to change quite quickly. Markets responded to that re-escalation earlier this week. Oil prices and government bond yields both rose because of renewed inflation concerns. With those inflation concerns, the market's now fully pricing in a rate hike in October, pulling that back from the previous expectation of December. Stock markets also reacted. They sold off, but then they settled down after Trump suggested that he doesn't think a full scale war will restart. And I don't think anybody wants that. Neither side wants a all out war again. So the adjustment in markets that we've seen this week should be fairly short lived, we believe. So the most likely scenario is that talks are going to resume. When that happens, then the potential for many of these market movements that we've seen over the last few days will probably unwind over the coming weeks, especially oil prices and bond yields.
So that's been the war has obviously been a big part of the story in the first half of the year, which once again was another pretty good, well, actually really good half for
Yep.
stocks.
Yep.
Okay for bonds, and again, if I'm sitting in a balanced or conservative type portfolio, so a 60-40 portfolio, 60 equity, 40 bonds, or a 40 bonds, 60 equity,
Yep.
I've had a pretty good first half, and I'm really running off of now what 4 years, pretty much almost 4 years of really outstanding performance, almost 8 years of performance in 4 years. So you still have all this stuff in the background,
Mm.
and again, those yields are ticking up, which again directly creates issues for the bond market, but ultimately creates issues in stocks. What are you seeing economically? Because the economy looks pretty good around the world. So what are you seeing in the second half of this year?
Yeah, you're absolutely right. The economic backdrop remains surprisingly resilient. The data that's coming in is better than it was a year ago. The positive forces that are driving the economy are better growth, or growth in AI related spending, fiscal stimulus, increased productivity. So our base case is for the U.S. economy to continue to grow because these positive forces are offsetting that drag from the energy shock associated with the Iran war. So there's more good things happening in the economy to offset some of those negative things that we talked about. It is worth noting that oil prices have mostly normalized from their
Yeah.
peak, even with this recent change this week. And we don't have a complete resolution in the Middle East yet. So we're seeing the oil prices are sort of getting out in front of that because they're anticipating a resolution. Inflation has already started moving higher due to that rise in energy prices since March, as well as some lingering effects from tariff increases from last year. So, as using U.S. CPI as an example, it hit 4.2% year over year, and that's up from 2.4% before the war. So we are seeing that impact on inflation. But if you look at inflation, the core measure, which excludes energy prices, the movement's not that as significant. It's up to about 2.9% from about 2.5%. So still an upward movement, yes, but not as significant when you pull energy prices out of it. Given the macro backdrop, central banks are now thinking about more rate hikes than cuts. But should inflation pressures prove to be mostly temporary, which is our expectation, those central banks may not need to hike as much as the current forecast would suggest.
So with that, the bond market, and maybe even go a little broader than just the government bond market. But if you look at spreads out to corporate and high yield, they're fairly narrow. Again, good environment, but you still got some risks on the table. So how do you see fixed income playing out? I know you've played around in fixed income a little bit in your
Yep.
portfolios over the last month or so. So what are you seeing there in terms of actionable things for investors?
Yeah, well, we've certainly seen the volatility in the bond market since the war in Iran began. Investors were adjusting their outlook for fixed income. 10-year yields in the U.S. have traded between about 3.95 and 4.65 over the last several months, sitting around 4.5% right now. So we remain underweight fixed income overall within the portfolios, but we've been tactically adjusting our bond exposures during this period to take advantage of some of this volatility and that wide gap in yields. The rise in yields initially offered a more attractive risk return profile. So we narrowed our underweight in bonds in May and moved our allocation closer to neutral at that time. Yields subsequently fell as inflation expectations eased following news that the US and Iran had reached a tentative agreement at that time to end the war. So we took some profits on that trade, sold those bonds out, and restored that previous 100 basis point underweight in fixed income. And so, while we're not changing our overall view of being underweight fixed income, we still tactically manage within that to take advantage of that volatility and to generate some basis points of return on behalf of our clients. So going forward, we
Yeah,
forecast.
just to jump in there, you kind of
Yeah.
nailed that one, didn't you?
I don't like to pat ourselves on the back because,
Yeah,
but our batting average on these types of trades is fairly good, and so we're quite pleased with the way that one what turned out.
yeah.
Still looking for more opportunities going forward. We think we're going to expect low to mid-single digit returns for government bonds, and so in order to sort of generate a little bit more return out of that, tactically managing the allocation is going to help with that. And then there is, as you mentioned earlier, potential for higher returns in corporate bonds. Although, as you said, the added compensation for taking risk in corporate bonds relative to government bonds is historically very small. If the macro backdrop remains supportive, those narrow spreads could remain in place for some time. And so we have fairly low allocations to corporate debt relative to history right now. But again, something that we tactically manage on an ongoing basis.
So the action continues to be in stocks, and
Yeah.
the question I get everywhere I go. I was in Winnipeg the last couple of days and out with investors, and it's just how much longer can this go? And it's not just tech. I think once again, and this maybe get your perspective on this, and we'll have some other people on over the next week to really dig into this specifically. But it seems, I got a basket of stocks that I track to sort of see where the momentum is and where
Mm-hmm.
money seems to be moving that I track. And it feels a little bit like we're seeing a little bit of that rotation that we have thought was happening about a dozen times over the
Mm-hmm.
last 3 years, and then the money just always ends up pouring back into tech, but and particularly AI. But are we feeling getting a sense that things are shifting and there's a broadening and maybe this just undying appetite for some of these tech names again that are particularly focused in AI is waning, and people are starting to look at some of these stocks that almost seem boring in comparison, but generally deliver pretty solid returns over time.
So, as you said, stocks have surged over the past year, driven by AI optimism, also driven by easing trade policy concerns and corporate earnings upgrades. Those corporate earnings upgrades are fairly broad based. So your comment about, is the stock market performance broadening to stocks outside of sort of the AI driven names? I would say yes, that seems to be happening. The biggest price gains, though, have been in indices with the heavy exposure to technology. So, for example, the NASDAQ, the S&P 500, MSCI emerging markets are all up very strongly year to date. And that powerful rally has driven valuations higher as well. So it's actually pushing many indices into what we would deem to be expensive territory. So, for example, our composite of global equity markets is now 20% above fair value, and that's the highest reading we've had since late 2021. And so it is we have to watch valuations. But one of the key reasons why investors are willing to pay that higher price for stocks today is that the earnings outlook is greatly improving and being upgraded at an unusually rapid pace. So for example, the consensus estimate for S&P 5 earnings has been revised higher by 20% over the past year. And that's highly unusual because usually earnings estimates are revised downward throughout the year. And the fact that we're actually getting upward revisions in earnings is quite a departure from the norm. So the main source of these earnings acceleration lies in the outsized spending by the AI hyperscalers. So that would be like the Microsoft, Amazon, Google, Meta, Apple, those Meg 7 type of names. But that spending is actually finding its way into the earnings of other companies within the index as well. Those companies that provide the ingredients for AI infrastructure, such as the chip companies and stuff like that. So where do the markets go from here? That's the big question. Can the rally continue? We think yes, for the time being. But that the returns going forward are probably going to be more moderate because of these valuation concerns. So, the current expensive starting point for stocks is consistent with low single-digit returns for stocks going forward. Although we do recognize that the variety of tailwinds that are currently in place could keep stocks performing relatively well over the near term. But they would be vulnerable if the outlook were to worsen given the lofty starting point. So if we see, the war to continue, if we see inflation rising, those types of things that are going to have an impact on the economic outlook, given the expensive starting point of valuations for stocks right now, they are vulnerable to a sell-off. So at the moment, we're maintaining a slight overweight in equities, given our view that stocks are likely to outperform bonds over the next 12 months. We have a renewed tilt towards U.S. markets. We had a regional bet towards Europe and away from the U.S. Earlier in the year, but we've actually adjusted that now, and we have more allocated towards the U.S. market because of their technological leadership, their energy independence, and then the robust earnings growth that we're seeing in the S&P 500 companies.
Yeah, and the U.S. dollar has continued to be strong, despite what's likely a longer term trend of the U.S. dollar weakening. But the war reversed that weakening that had started really a couple of years ago when interest rates peaked in the U.S.
Agreed. We still have a view that the U.S. dollar is in a longer term bear cycle, but that we're in a period of strength right now because of that sort of U.S. market leadership and also because of the volatility around the war.
Yeah, and so you wrap that all up, and I was out with a lot of investors over the last the last few weeks, and what do we do? What should we do? What's the right answer? And I said, that's why I'm going to get the queen of diversification on, because more so than any time I can think of in recent times, I think diversification is the answer right now, and I bet I'm not going to get a whole lot of an argument from you on that point.
No, not at all. I mean, you can see the performance of the various asset classes, the various equity regions around the world. Some are doing really well, some are not doing as well, and trying to pick which one is going to do well at any given time is to me is a bit of a fool's game. So why don't you just own a diversified portfolio of a variety of different investments or asset classes or strategies? Try to take advantage of volatility and opportunities in the market to tactically manage between those. But ultimately, you'll get a much smoother and more consistent return experience if you have that diversified approach to your investments over the long term.
Yeah, so you're going to get a little bit of the exposure to some of this high flying tech stuff, which you don't want to dismiss what's happening in that space. This is revolutionary technology. This is world changing, life changing technology that's in its infancy. So there has been money to be made there. So sometimes you've got to stick your neck out and poke your nose into those areas. But at the same time, you don't want to overdo it, and the market has a way of sneaking up on you and reminding you that you've overdone it in a particular space. And this is where that diversification, and again, hopefully, I'm kind of hoping that we see a little bit more of that broadening that we've been talking about, and that we finally see, I'd say little bit more of a normal type of market as we move forward. But that diversification right now, because of what's happened in markets over the last 4 years, I think is just absolutely critical. And of course, nobody does a better job of it than you.
Yeah, thank you. I agree with you. And it's like, for example, like we talked about the emerging market index being one of the strongest ones, and the fact that we have an allocation to EM equities within the portfolios has actually had led to stronger results. I think the MSCI Emerging Market Index is up 28% year to date, and I think it's the strongest performing index globally. Yeah. So just having that allocation to EM has really helped portfolios, helped the performance of the portfolios, and added to that diversification, right?
Yeah, and then the little tweaks and little tactical moves that you've made, like you suggested in fixed income markets. Again, that's where you can again do little things, not extreme, but little things that add. And I think you always talk about. I'll let you use the actual quote of what you're trying to do there. But it works, right? And
Yeah.
and and I know what do you always say? I think it was an old Dan
Scratching
Tornis
out the
line of
inches.
yeah,
Yeah.
scratching out the inches, yeah.
Every basis
And
point counts. That's the other one too, right?
every basis point counts, and
Yeah.
that's really, it's the kind of market where that seems like the right approach, along with the
Yeah, for sure.
diversification.
Yeah, you don't want to be. Dan Tornis usually uses a baseball analogy for this, and he says you don't
Yeah,
want to go to the plate and swing for the fences every time, because you're going to get that wrong, or you're going to get struck out 90% of the time, or more. So we like to sort of take small, consistent, measured bets over time to generate, as using the baseball analogies, singles and doubles, are so
yes,
they get that more consistent result. Because you take a big bet in a portfolio and you get it wrong, it's going to have a pretty painful impact on performance. Whereas you take small, measured bets consistently over time and get them more right than wrong, is going to add to those basis points of relative performance for the clients.
yeah. And so yeah, and I guess baseball analogy is very effective last fall with the Blue Jays run. Blue Jays mediocre season this year, not quite as
Yeah.
impactful, but
Mm.
but I think everyone listening gets the idea that you can do some little things around the edges to add a little bit, and if you can do that fairly consistently and be effective in doing it, you're surprised at the end of the year how much you've been able to add on, and that's kind of what the approach that you've taken, and it's been very successful over a number of years now.
Yeah, and I would be remiss, though, if I didn't mention that you need to have access to the information to be able to make those tactical trades within the portfolios, right? So the vast amount of resources that we have behind our tactical asset allocation process in terms of macroeconomic strategy, asset class expertise, so that we have the information to make informed decisions when we're making tactical changes in the portfolios, is very important. I think it's challenging for individuals to be sitting at home in front of their personal computers and have that access to the information to make those trades and be successful on a consistent basis.
Yeah, watch the World Cup, enjoy the nice weather, which isn't always around here in Canada, and let the pros take care of things. And one of our favorite pros is Sarah Riopelle. And Sarah, thanks for joining us again, and we'll get you on the next time you're tweaking the portfolios.
Great, thank you.
This podcast has been provided by RBC Global Asset Management, Inc., RBC GAM, and is for informational purposes as of the date noted only. It is not intended to provide legal, accounting, tax, investment, financial, or other advice, and such information should not be relied upon for providing such advice. RBC GAM takes reasonable steps to provide up-to-date, accurate, and reliable information, and believes the information to be so when provided. You should consult with your advisor before taking any action based upon the information contained in this material. All opinions constitute our judgment and are subject to change without notice. The information presented here is provided in good faith without legal responsibility. RBC GAM reserves the right at any time and without notice to change, amend, or cease publication of the information.